of interest on reserves has become a central pillar of the Fed's post-crisis monetary policy framework. Since the transition away from the pre-2008 scarcity model, where reserves were tightly managed to influence the federal funds rate, the Fed has relied on an ample reserves regime using administered rates like interest on reserves to maintain control over the short-term rates. As of February 2025, nearly 19% of the $18 trillion in bank assets were effectively loans to the Federal Reserve earning interest. Given this structural shift, how feasible would it be for the Fed to return to a scarcity-based framework where reserves earn little or no interest? And if interest on reserves were eliminated, what would be the impact that would have on the Fed's ability to unwind its balance sheet and manage policy rates?
So we're in an ample reserve framework now, and that's a good thing. That's a result of the global financial crisis and the desire to have lots and lots of liquidity and large liquidity requirements for our largest banks in particular. So that's a good thing, and that enables banks to keep lending through stress and that kind of thing. If you were to want to go back to a scarce reserves, it would be a long and bumpy and volatile road. I wouldn't recommend that we undertake that road. It would not save any money. There's an illusion that it would save money. That is not the case. And it would also not make credit more available. This, in effect, I would say having a lot of liquidity in the system, which is what goes with ample reserves, make sure that banks will be able to continue to lend. So we think it works. And I think unwinding it is a policy choice which could be executed, but it would take years to execute and it would be challenging and quite volatile.
Thank you. I've just got about